And
A 1030.
not to cut you off, but right
Oh,
there,
sure.
there is very short timelines where in a 1031 they have to identify which properties they want to buy, and then they have to close within a certain time frame. And what we see often is people get into a standard 1031 and end up buying something they really don't want or like, but they had to do something because of the tight deadlines.
I would like to take a 10-minute break and then
Three, two, one.
how do you have the ability to analyze stock?
Welcome to the Generations of Wealth podcast. I'm your host, Derek Dombeck. And you know what? Today, just like every show, I'd say it, we have, honestly, this is a kick-ass show. That's what it is. This conversation goes so deep into some really in-depth stuff on how to save tax dollars, utilizing 1031 DST exchanges, getting into opportunity zones, all kinds of stuff that is very, very next level for many of you listening, but still really important to know. Even if you're not there today, it's really important to know what's available to you. So before I bring on our guest, we are going to talk in this show about different types of investments and alternative investments, and our guest is an expert in alternative investments. But this is all about connecting and building your network, and so I want to be that resource for you. If there's something I can do, somebody that you need connecting with, or you need help on something, don't hesitate to reach out. DerekDombeck.com or thegenerationsofwealth.com. And with that, let's bring on our guest. And here he is, all the way from Castle Rock, Colorado, Jon Lontai. Thank you so much for being on the Generations of Wealth show.
Thanks for having me, Derek. I really appreciate it.
If you wouldn't mind, just tell the listening audience a little bit about yourself. Our conversation today is I already know from our previous conversations, you're kind of an alternative to a lot of different real estate typical investment type stuff. But why don't you just give us a quick background?
Sure. Yeah, you make a good point. There is no widely agreed on definition of alternative investments. For some people, it's artwork, collector's cars. For other people, it's private equity. But by way of introduction, I've spent about 10 or 11 years at a traditional brokerage, TD Ameritrade, that was later purchased by another bigger brokerage. I now specialize in alternative investments. So I work with a fiduciary RIA called Arcus, based out of Jacksonville, Florida, and as well as Atlanta, Georgia. And we focus primarily, again, on alternatives, which for us means private equity, private debt, and private real estate. And increasingly in the last few years, more so on, which will be a topic for today, is tax efficient alternative investments, ways to manage capital gains by way of the 1031 and variants of the 1031, deferring capital gains. So within that alternative umbrella, there are a lot of real estate adjacent tax strategies that are catching on very quickly.
Cool. Well, I do know that you've not always been in Colorado because you went to school in Illinois, and
Correct.
my listeners know I live in Wisconsin, so Illinois is kind of our basement. But are you originally from Colorado?
I'm originally from Peoria, Illinois, right in the middle of the state. Lived in Chicago for a couple years before moving out, fleeing Illinois, if you will, to come to Colorado with my family and three kids. And by the way, I have passed the Cheddar Curtain before, so I have been up there before. I've
We let
actually
you
been.
in? How did we let you in?
Just barely. I had to fudge some documents, but I've actually been all the way up to Cable, Wisconsin. There's some perhaps well known around your parts, but there's some world class mountain biking up there in is it Hayward
Yep.
or Howard in Cable? There you go. And then of course a lot of snowmobiling in the winter. It's really a beautiful whole nother world up there in northern Wisconsin.
Yeah, and I mean Peoria is pretty much surrounded by cornfields and soybean fields. So
Correct.
got to get up. I understand why you went to Colorado. So
Yes.
anytime I see somebody that was in or around Illinois, I got to give them a little crap. It's just the way it goes.
Yeah, no problem at all. Happy to receive it.
So you got out to Colorado, and let's talk about what do you do really to help serve the real estate investor community, or not even necessarily the investors, but people like you said earlier, trying to offset or move capital gains to a different location. Let's get deep.
Sure. Well, when I just going back ratcheting back just one more
Mhm.
increment, when I was at the traditional brokerage, I started to realize that when some of my larger clients, it was harder and harder to add value because of technology. You could buy a stock for the low price of $0. Commissions were zero. You could get a financial plan using software really for free, right? If you wanted a diversified portfolio, you could buy an ETF that had thousands of stocks. So diversification's covered. So there was less and less that a traditional financial advisor could do to, I know it's a buzzword to say, or phrase to say add value, but it's true. It was harder and harder. If someone wants a bond, they could pick up the phone and buy a bond so what I realized, especially with my higher net worth clients, 3 to 5 million plus, really the only way I was able to really bring anything meaningful to the table tended, not for everyone, of course, but tended to involve alternatives, private equity, private debt, and private real estate being the three primary ones. And so that really led me to that change of leaving that regular kind of brick and mortar, old fashioned brokerage to being at a fiduciary RIA. Another light went on soon after. I started to learn more about these products, and this is kind of speaks to your question. I started to learn more about these products for tax advantage alternatives, things like the 1031 DST. There's a variant of it called the 721, the Opportunity Zone, which the Tax Cuts and Jobs Act of 2017 brought about, which is a phenomenal way to save on taxes, whether you're selling real estate or selling a business or you have a concentrated stock position. And I was networking with a old friend of mine, also from Illinois, and I talked to him about he's a real estate agent up at Fort Collins, and I had asked him about that, and I'm like, hey, do you guys do that? And he was like, he didn't really understand what a 1031 DST was. He's a phenomenal real estate agent and has years of experience, but the light went on to reiterate when I realized that here's a high performing real estate agent in a growing market, homes in Fort Collins, Colorado, just like Denver, just like in Castle Rock around me, have been increasing in value at a higher than average clip. And the fact that he really wasn't up to speed on that kind of surprised me. And again, he's a top 5 percenter in terms of performance, so he knows what he's doing. And I presented to a group. I think they put on quarterly or monthly meetings, and I presented to about 40 or so agents there. And the theme continued. A lot of them just weren't speaking to capital gains. And I got the impression that being a real estate agent is not easy. It's survival, right? A lot of real estate agents might only sell 5 homes a year. It's very difficult to make a living. And so I think that there might be a tendency to just be really focused on the transaction. And if there's a strategy or a capital gains discussion that comes up, I wonder if a lot of real estate agents don't just, maybe avoid it just to kind of keep things simple. That maybe don't want something to derail the transaction. So a light went on there when I realized, CPAs aren't really speaking to a lot of these strategies. If they are, they're maybe familiar with one or two, but not really the whole thing. And so I think the opportunity to be a generalist, somebody who can speak to an opportunity zone or a 1031 DST or other tax advantage strategy and put them all on an equal playing field. In other words, I'm not I'm not a product specific. Hey, my company does DSTs only. As your listeners know, that means Delaware Statutory Trust, meaning that the 1031 is exchanged into that trust and it's professionally managed for you, and you get a monthly check in the mail. Instead of rent, you just get that check in the mail. And then in about 7, 8 years, roughly, if the management sells the property, then you get that money back. So just a quick overview of a DST, if I use that phrase. So that's when I started to focus again, a little bit more on these real estate adjacent, because I sensed that there was a need, due to a lack of focus on some of these strategies.
Is there kind of a threshold of gain that you want to see before a DST makes sense? Like, is it if somebody's going to have $100,000 gain, is it worth trying to do a DST versus $1 million gain?
Well, the economics do scale. There are generally minimums. I think most DSTs that I see have a $100,000 minimum. And so if there's no debt there and it's paid off, that might make a lot of sense. I think the first gap you'd want to look at is, number one, do they want to be a passive real estate investor?
Mhm.
If that $100,000 gain means that they have to give up their joy of owning a duplex and having the flexibility to, or maybe it's a second home and they want to visit it. So a lot of people just want that tangible real estate and they don't want to give up control. So not to deflect your question, but I think that's the first question to ask, because that's going to weed out a lot of people. Having a piece of real estate you can walk into and knock on the walls is a lot different than somebody sending you a check on a monthly basis for half a decade. And so that would be the first one. The second is liquidity. If somebody wants that $100,000 of gains mitigated, but needs liquidity, then again we have an issue where that DST is probably not a good fit. Because if those monthly checks are not enough to meet their liquidity goals, then it's probably something that should be weeded out. But as you know, alternative investments are not for everyone. And the primary reason for that, and I know I'm using the word alternatives very vaguely here, but it's often because of liquidity concerns. And so those would be the first few things. If both of those worked out and they met the minimums for a DST, had no liquidity concerns, didn't mind being completely passive and not being in control of the property, then as long as they're okay with that, the economics would make perfect sense, whether it's 100,000 or a million in gains, in my opinion.
So let's just throw some hypothetical deal in place. Somebody's got a property, it's got $1 million worth of gain, and just go through the process, right? They are okay with the liquidity, okay with getting monthly payments, but
Sure.
walk us through it.
Sure. Well, the first thing is I'll just do this for just to start really high level. If they did a regular 1031, which have been around in some form or another since about 1921, last I checked, that's when 1031s became a thing in the U.S. Then they would be selling that property and deferring it into another property that they're responsible for. Right. That would be a situation where my firm and I really wouldn't be able to help much at all. A realtor could help them with the sale and the purchase, and that would accomplish just a standard 1031.
And
not
to cut you off, but right there,
Oh, sure.
there is very short timelines where in a 1031 they have to identify which properties they want to buy, and then they have to close within a certain time frame. And what we see often is people get into a standard 1031 and end up buying something they really don't want or like, but they had to do something because of the tight deadlines. Would you agree?
You're exactly right. No, I think your question can branch off in a lot of directions, and I'm glad you steered us in that direction. So a lot of times what folks will do is they will identify two properties because you have 45 days to identify, 180, if I'm not mistaken, to close. And they'll identify two properties that they want to 1031 into. And if they have an astute advisor, oftentimes that third one, they will choose a 1031 DST as a backup. So that way, if there's an issue with the roof on the first property that they thought was the property of their dreams, and maybe maybe the second property has another unrelated issue related to the seller financing or radon or whatever the issue might be, because things happen. Then that 1031 DST is essentially a backup, and then you don't miss that window. Especially if you're talking a million in gains or really anything in gains, to miss out on that 1031 and just say, hey, we need to buy something, that's not a position you want to be in. Especially when buying real estate, you don't want to feel like your hand is forced. You want to feel like that's the right deal, the right place, and so forth. So that DST, as a backup is a very good idea, which you alluded to. I can get into another aspect of that that's adjacent to that, and you can actually use a qualified opportunity zone, a QOZ, also as a backup. Again, that there's maybe even a slightly longer time commitment with those, up to 10 years, whereas the DST is usually figured as about 7 to 8 years. But again, typically what I do is I coordinate with their CPA and an estate planner if need be, and figure out the right mix there. Because I not to confuse the matter, but you could even do both. You could do part QOZ, part 1031 DST. As well. So, but again, your point's exactly right. You don't want to fall afoul of those identification and all those strict rules with a regular 1031.
Okay, so we're done with the 1031. We know that's not the plan for us. Now we've got this $1 million gain. We want to go into a DST. What are we going into?
Sure. So first, I'll just preface the primary reasons why somebody would want to do a DST and not just a run-of-the-mill 1031 would be that they don't want the responsibilities of being a landlord. They don't want to deal with Airbnb guests. Maybe they just want to have more time to spend with their family and move to Arizona and play pickleball or do whatever they want to do, right? And so by doing the DST, to your question, you essentially become a passive investor. A lot of companies out there just do DSTs and that's all they do. As a RIA and an investment advisor, we work with several companies that offer DSTs and other real estate investments. So for example, I might have an industrial property in Georgia as a DST. I might have like a student housing, somewhere in the Sun Belt. Or something like that, or even like a rent to own, like a single family home type of neighborhood. So investors know what they're going to have. It's not a black box of, oh, I'm investing in this pool of real estate. It's you actually know the physical address of what that DST is. Generally speaking, right about now, anywhere from 5 to 6% at the most. There's not a huge spread in terms of the cash that those tend to generate in terms of doing the math and expecting what you might get on a monthly basis. And other factors, again, not to stop me if I'm adding too much complexity here, but a lot of times, especially with larger DSTs, they may want to divide it up into two. So they may say, hey, I like that industrial, I like that storage facility, in Utah, or something like that. So that way they can be geographically diversified and not just have one sponsor or one building providing all of that DST. And so that's essentially how it works. You get what some people call mailbox money. I mentioned the lack of liquidity and also I should rephrase that is also lack of control. The folks that manage that DST, they may decide to sell that DST in 6.5 years, 7.5 years, 8.5 years. You don't really have control over that. And so investors need to be comfortable with that, and accept that as a feature and not a bug. Because when that DST is sold, hopefully at a profit, you get that profit too, of course. And then you have the ability to either do another 1031 of the traditional variety or keep it in the DST lane and keep it passive.
So if for some reason it's sold in 2 years, you're not all of a sudden getting your capital gains. You're just jumping into another alternative investment of your choice at that time.
Correct. That is highly unlikely, but I suppose anything's possible. 2 years is awfully short. Most people say 7 to 8 years, but let's say that happens. You essentially get a call from someone like me and say, "Hey, that DST looks like that's getting sold." The more if that happened, and again, 2 years is an extreme example, they probably got a really good deal on it because they're looking out for their investors, and they're not going to accept if someone throws them a lowball deal for the industrial property, for example, they're not going to take it. So they would have had to get a really good deal presented to them, and then they would get a call from me, and I'd say, "Hey, what's the plan? Do you want to do another 1031 DST? You can convert it into other things like if you want it to be even more passive, you could do what's called a 721, which essentially converts those into shares of a REIT, which again, your listeners will know, real estate investment trust. So they'll just have, it'll kind of look like mutual fund shares. The primary thing to be aware of with that option, it's often called the UPREIT, is that your 1031 journey is over at that point because you will basically own that REIT. Once it's converted into REIT, there's no 1031ing in the future. So if somebody's wanting to just put this in a trust and let their heirs, maybe they have a complex trust and it's going to go to 7 different kids or grandkids, and they just want it to be easy to distribute, as opposed to handing your kids a key to a warehouse and they look at each other and say, "What's next? What now?" Then that structure, the REIT structure called the 721, can make a lot of sense. In practice, Derek, when the rubber meets the road, oftentimes it's the 1031 DST followed up by another 1031 DST. But it's good to know that you have that option of, hey, you know what? Maybe I'll buy some land for hunting. Maybe I'll, buy that ski cabin I've always wanted. In, 6 to 8 years, you could make that decision at that time, but still have the flexibility to keep it passive with the DST route.
So let's talk costs. Somebody, again, we're just going to keep it on that $1 million gain. There's going to be a cost to the transaction to do the DST 1031. And then you mentioned what they get kind of on a monthly basis or quarterly basis, however it's structured, and then what they get 7 to 8 years later. Of course, that's based off what that DST actually does sell for. So what's kind of some guidelines? We're not trying to pigeonhole you into exact dollars, but.
Sure. Well, it's hard to do that, and I've tried to get numbers and boil it down to an exact number because I'm a keep it simple kind of person. The reason it's hard to do that with a DST transaction is a lot of times there's financing costs and things that are difficult to attribute perfectly. Like there'll be costs for running the like in the case of a hotel, there's costs of running the hotel and there's other expenses and such. I've done my best in terms of just all out management. I've come up recently with about 5% as kind of like that cost of running the building, if you will. Somebody's got you can't just have an elevator you have to have it inspected, you have to have it maintained, you know what I mean? So there's a lot of those expenses, again, hover around that percentage. Depends on financing, depends on a lot of other things. Um, as when I do DSTs, we don't charge. Typically, there's a 5% sales charge, and then another 1 and 1.25. And we don't charge either of those, which can save people quick math around 6.5% or so. And we do that because we are fiduciaries, and we don't look for the high. In other words, we pass that savings to the investors. When we use REITs, in the case of a 1031 that results in a 721, we also use the lowest share class of a REIT. So without putting everyone to sleep, a lot of times people will do different share classes. So they'll have a share I, they'll have a share Z, and they'll F, and there'll be different letters. And some of those have a higher sales load to them, or or a higher annual fee. We always use the lowest cost share class as a fiduciary. So we avoid conflicts of interest. So the only thing, if we choose one DST over another, company A over company B, nobody sends me a set of golf clubs for that, right? So I'm agnostically looking at the landscape of DSTs or opportunity zones or other mitigation opportunities. And so that's part of what makes us an independent fiduciary. Our fees start around, if someone invests just $1 million with us or so, or 2 million, our fees start at about 1%. And then if someone has 5 million or more, we tend to negotiate that down quite a ways, depending on the size, which is not an uncommon structure of RIAs. So we don't charge more as an RIA simply because we offer alternative investments.
Right. Okay. So depending on what's invested into, there's a monthly payment that comes to the investor. When the property sells, they get the gain minus fees, expenses, and all that stuff. Correct.
And I could, I don't know if you've looked at one lately. I could send you a prospectus so you could see the interest charges and everything. And how the cost of maintaining the facility. It's not easy to pin down and say, oh, the ongoing cost of this building is, and whittle it down to an exact percentage, as I said. But for the interest of transparency, we always go through all of that and take a look at everything, so everyone knows exactly what's coming from where. So just wanted to reiterate that transparency.
Yeah, I'd be happy to have you send that to me, and I'm not sharing with the rest of the audience. Sorry, but no, I'm kidding. I guess my curiosity goes to who's actually establishing the DSTs, and what does it take to establish that for the investor to buy into, or to, for lack of better terminology, exchange into?
Sure. Well, there's a lot of, I could name a couple of the high volume companies that do that. The largest by quite a bit is called Inland, is the name of the company. I'm not endorsing any of these particular companies. These are, if you do a Google search for DST providers, you will see these same companies. Companies like Griffin Capital is one of the biggest QOZ providers. They might be the first or second biggest QOZ providers. And so these are essentially real estate companies that specialize in one case, we have another provider that specializes in hospitality. So they are experts when it comes to hotels. They do financing for hotels, so you can invest in a private real estate fund that just does financing for hotels, for example. And they also do DSTs, 1031 DSTs. One quick note, by way of definition, I don't know the exact date, but it might have been around the late 80s. The DST structure came to be in the tax code. So if you let's say 5 of your hunting buddies wanted to own hunt for deer on some land somewhere in Wisconsin, you guys could set up a DST that essentially said, "Hey, we all own this, and the structure of this is a DST, a Delaware Statutory Trust, right?" And you guys could do various things with it. You could do a cost segregation study. It's up to you, right? I just want to draw that distinction because a DST is a common structure for shared real estate ownership. The 1031 DST came about in 2004, and that's when the IRS ruled that you can use a DST as your replacement property and the second half of a 1031 transaction.
Okay.
So I just so nobody gets confused, I just want to mention that if I say DST in the context of this conversation, assume I'm speaking about a 1031 DST and not just the ownership structure unto itself. Go ahead, Derek. Sorry to interrupt.
I was just going to reference that. So the ownership of a DST, not the 1031 DST, is very similar to a syndication in what I'm hearing.
Correct.
Okay.
Correct. I mean, if you think of like, maybe this is not a great way to put it, but like an LLC,
Mhm.
an LLC is an ownership structure. It's so again, probably not a great comparison, but the DST is a real estate specific ownership structure.
Okay. No,
Correct.
that's great, and it's a good clarification on it as well. Because like
Yeah.
I do syndications. I'm putting together a syndication right now, and never even considered or thought about what that could look like as a DST. And now I'm going to go talk to my attorney. But
Yeah.
well,
CPAs too can often chime in on that. I'm sure you have a team together that looks at that kind of stuff. Just like the S Corp, C Corp discussions, what's right for one person is not right for another, but definitely good to have that conversation as a due diligence exercise.
and they all have positives and negatives, right? It just depends on what
Correct.
you're trying to accomplish.
Yep.
Well, I'm pretty sure DSTs are becoming more and more popular. You and I chatted a little bit before we actually started recording. What have you seen as a trend with 1031 DSTs?
So there's a group called Dell Mountain Consulting that keeps a very close eye on DSTs, and they have data going back probably 15, 20 years. And the 2025 was the largest year, or I'm sorry, 2025 was the second largest DST year by volume. Off the top of my head, I could be wrong on this, but I want to say it was in the 8 billion range. And it was up significantly, somewhere in the range of 40% growth between 2024 and 2025. Demographic reasons could play into that. A lot of people just want, and as they enter retirement, they would rather just have that passive ownership structure. So again, they're not receiving those calls from the landlord or as a landlord and having those responsibilities. You change a certain amount of water heaters in a home, and eventually you just want to hang that hat up and have that passive ownership structure. So there's a lot of reasons related to the great wealth transfer that you've heard of that would attribute to that. But no, it's been very steady growth in DSTs, very, very strong growth, in fact.
Well, and we've seen this very fast uptick in the last 10 years of property values, and a lot of those baby boomers, as you mentioned, they are, I guess I would say the IRS is salivating, saying we're going to gain all this money, right, from these capital gains. And I don't know, how do you feel about the IRS and regulations as it pertains to these? Do you think that they're pro or con to the DSTs, the 1031 DSTs?
Just to clarify the question, do you mean recent legislation?
Yeah, well, so I'll kind of rephrase the question. We've seen especially like with other retirement account type of transactions or holdings like IRAs, Roth IRAs, inherited Roth IRAs, there's always this chatter that at some point the government's going to start to kind of pull back because there's a lot of money that the government isn't able to collect today because it gets pushed off into the future. Same thing with 1031s. My opinion is the government, it's not in their best interest to do that. They need transactions, they need things moving forward, and there is a small percentage of people that actually utilize what's available to them. The masses don't understand any of this stuff. They don't listen to the Generations of Wealth show or talk to you, John, right? So I
Yeah.
don't feel like the government is going to try to clip our wings, but I'm curious what your thoughts might be.
Well, no, that's a good question. That's always a risk. Future legislation risk is is often discounted because it's an unknown. We don't know who is going to be the president in a few years, and then who's the president after that is. They may be inclined to raise taxes or lower them. We just don't know. So a lot of times people kind of don't consider that question. I think there's a lot of strategies in place right now. For example, the opportunity zone I've mentioned a couple of times, because of the passing of the One Big Beautiful Bill, that is actually relaunching January 1st, 2027 as what people call the Opportunity Zone 2.0. So they identify neighborhoods that need revitalization, both rural and urban, and they allow people to invest in that up to 10 years. And it's a very good way to defer capital gains. So if you're somebody who's selling a business and you're getting capital gains within the business and the property, that can be a great way to just say, hey, I'm not just doing a 1031 of some variety for the real estate. I'm taking care of capital gains as is. So that's, I would just say to your question, that's a recent effort to give investors an opportunity to defer taxes in a pro-growth way. I think a lot of people do Roth conversions, and maybe this is off the real estate topic. If somebody does a Roth conversion from their traditional IRA, they're essentially placing a bet, whether they realize it or not, that I'm going to pay the taxes now. Convert it to the Roth. The Roth is tax-free here on out, right? You also don't have required minimum distributions from the Roth. But guess what? You're also saying, hey, if the tax rates in 10 years are going to be higher, just a little bit higher, who knows, right? You've already paid them. So that's a way that a CPA, if somebody was concerned about future tax rates, I don't want to call it a hedge, but that's a way somebody could kind of take that that option off the table. The flip side, of course, if tax rates stay the same or go down, so again, it's really difficult to do and difficult to know. It's like in, pick a sport like NASCAR. One year they're going to say, hey, the tires can't do this because of aerodynamics, or, the rules are always going to change. And I think that's why being in touch with a real estate attorney, an estate attorney, and a CPA, and expecting results from them and expecting them to really pound the pavement is really important. The amount of legislation, I mentioned the One Big Beautiful Bill and the Tax Cuts and Jobs Act. There's probably 5 or 6 more pieces of major legislation that have changed the tax landscape significantly in the last 10 years. I couldn't rattle them off all on the top of my head right now, but there are a lot of them. So for investors who DIY their taxes, that's something to be aware of, because there might be more pitfalls or perhaps missed opportunities, more likely than they might realize. Because unless you're staying up on this and, this is your passion of keeping up with tax rules, which may or may not be, but it's basically harder. If you were doing your own taxes in 1995 and 1998, not much change between those 2 years. But in the last 10 years, things have been changing significantly. to your point. So staying up on that is really important.
Yeah, and I kind of preach this a lot to people, not necessarily just in this show, but just people I coach or people I interact with. You have to get multiple opinions from multiple sources and come to your own conclusion, because a CPA is going to be thinking strictly taxes. An attorney may be thinking strictly liability protection. One may, liability protection might cost you more in taxes, but what helps you sleep at night? And
Yeah.
so it's just very much building your network. That's what we do here at this show, just help people find people to be part of their network like you, right? And that's a great
Yeah.
segue into, if people want to work with you or get, your feedback,
Perfect.
whatever, what's the best way for them to find you, Jon?
Sure, sure. And real quick, I could give a number and an email if you can flash it on the screen too. I would like to riff if there's time on that CPA point you made just a
Go
moment
ahead.
ago.
Yeah,
Do you mind?
it's my show.
Um,
We can go as long as we want.
Great. I don't have a clock here, but as far as CPAs goes, and this is not picking on CPAs whatsoever, but generally speaking, it's a lot easier for a CPA to recommend something very straightforward and tangible that gets you a tax outcome today, this year, right? Like a write-off, for example. And then, hey, you do this, check this box, you get this write-off this year. It's less common, and you really need, that's why getting a second opinion, as you said, is so important. It's less common, but probably more beneficial to get tax advice that spans 10 years or even 5 years, or maybe even longer if you have some unique structure within a trust. But that's how people pass generational wealth onto the next generation, is often through those trusts, and that's one of the most efficient ways to do it. Generally speaking, of course, that's not going to be right for everyone. The other point I want to make with regard to CPAs is that there is a very significant CPA bottleneck, and I correct me if I'm wrong, but it's definitely this way in Colorado and a lot of other parts of the country. So tell me if it's any different in Wisconsin. But people who graduate with accounting degrees in the last 20 years or so have a much higher propensity to just go to work for a big company and be an accountant for a large company. You get time off, you get 401k, everything's good. A lot of CPAs that are just kind of your local CPA with a sign in the front door are becoming less and less common. So what that means is that if you have a good CPA, or you look up a CPA in the phone book or online, you call them, you might just get a recording or an automatic email that says, "Hey, we're not taking new clients anymore.
Mhm.
Have a nice day."
Yeah.
And so there's less of them out there, and it's harder to get good advice. It's mid-March right now, roughly. Between now and the tax deadline in April, CPAs are just kind of have their head down and they're grinding. They're just putting in big, long days. So that CPA bottleneck is important for your average investor, because some CPAs are very transactional. They want their business model is to do the most returns possible. Others are more less transactional and more hey, let's look at all of these strategies, whether they're 2 years or 6 years. And they're the ones that are going to be more likely to recommend more esoteric things that require coordination between maybe your financial advisor and your CPA and your attorney, because that coordination takes time.
Mhm.
So if that CPA has no time, which a lot of them don't, they're not going to say, "Hey, we need to talk to your financial advisor and see if you have any, embedded capital gains with your taxes, because we could offset some of those or defer some of those with this loss, and, depreciation studies and all that kind of stuff." Because it just takes time.
Yeah,
So
100%. 100%. And the CPA factories, I'll call them, certainly they're working on volume. Their CPAs are getting paid a wage or a salary. The more volume
yep,
they can pump out, the more money comes into the firm. In my
yep,
23 plus years in this business, I think I'm on my fourth CPA, and I've had the one I have now for a long time. But I wasn't afraid to fire somebody for that exact reason you said. If they're not giving me the personal attention or asking the right questions or at least talking about year-end business structure or next year's business plan,
Yeah.
that's not who I want. And the other one that really pisses me off, whether it's attorneys, CPAs, any professional, if they don't know and they're going to charge me an hourly rate to go learn, that's not who I want to deal with. I want to pay the person that already knows or
Yeah.
is at least willing to admit, I don't know, let's figure it out together. But I don't want to pay for somebody to get educated on something I'm
Yeah.
paying them to already know. But I'll
That's a good point.
get off my soapbox on that one.
No, in my own experience, I mean, there's a lot of CPA, and again, I don't want to sound like I'm picking on them, but there's a lot of CPAs who just are not up to speed with alternative investments, and it makes sense that they're not. They're CPAs. Their ongoing education is going to be very much in the tax lane. So it's understandable that some of them are not up to speed on all the alternative investments out there. There's advanced forms of tax loss harvesting, for example, that generally tax loss harvesting in the form of a portfolio has been around since the 1990s. In the last 6 or so years, there are advanced forms of that have popped up that are able to generate capital losses at double or triple the rate that they could just 10 or 15 years ago. And I've shown a few CPAs that, and not one have I presented to them that they were like, oh yeah, I'm aware of this. They're simply not, because again, it's an alternative. Unless you're in the investment world and you know about alternative investments, you're going to be unaware of that. And so I think they're going back to some of that opportunity of being a generalist, being aware of from a high level about some of these things and how these things work together, kind of helps to get out of that silo mentality of, oh, my CPA is over here, my financial advisor's over here, my real estate's here. And sometimes those silos simply just don't communicate with one another. And so having a generalist on your team or somebody who is willing to pick up the phone and explain something to a CPA or an estate attorney, it can be very, very valuable.
Absolutely. Well, John, let's wrap it up there. I'm not going to hit
Great.
you with actually, I am going to hit you with the question that I stump everybody with. What is one question I should have asked you that I did not? And it can be about anything.
Oh, wow. What's my favorite thing to do in the Colorado mountains?
What's the answer?
Mountain bike with my son.
Love it. Absolutely love it. And I love the Colorado mountains. Spent many, many years out there chasing elk and doing some
Nice.
skiing in Keystone. So,
Very nice.
well, John, how do people get in touch with you?
Sure. I'll you've got all of it to flash on the screen if you'd like, but my email is jon .lontai at Arcus, ARCUS, CP, like Charlie, P like Paul, .com.
Okay.
And do you want to do the same with the phone number on the screen, or do you want me to recite it for you?
Yeah, you can just throw your number out there and we'll
Okay.
get it in the show notes.
Perfect. 720-445-6649.
Awesome. Well, thank you very much for that in-depth conversation. And for everybody else, you know the drill. Anybody you know that should hear this information, please share our show, get it out there on social media or anywhere that you can, and give us all the like and loves that help us grow the Generations of Wealth podcast for you and for everybody to build a network. So until our next show, go live your vision and love your life. See ya.